Hey everybody, my name is Matthew Sambanis. I'm a certified public accountant. I've been practicing accounting for close to over 20 years. And in today's video, we are going to discuss the real state of the economy, the consumer, the stock market, retail sales, inflation, and most importantly, what you care about most, which is how to profit off of all this craziness that's happening. I thank you in advance for watching this, and please be sure to like, comment, and subscribe if any of these topics tickle your fancy. This channel is dedicated to finance, economics, how to make money, business planning, and things of that nature. And if you'd like me to do a video about anything in particular, leave a comment below and I'd be happy to do it. Oh, excuse me. So I did a similar video yesterday, and long story short, as I woke up today, and it was just an affirmation of what the video was yesterday, which was literally 4 or 5 huge companies coming out. Best Buy announced their sales would be down, and they lowered their full year guidance. Lowe's disappointed for the third quarter and lowered their full year guidance. Home sales are also crashing. American Eagle also lowered their full year guidance due to a weak consumer and high inflation, and their stock was down 17%. And Ford, who was going to invest $3.5 billion in an electric vehicle battery plant in Michigan, is going to only do 43% of that. So I guess about $2 billion due to high labor costs and other, things of that nature. So another also article that came out was Jeff Bezos is planning on selling anywhere between 8 to 10 million shares of Amazon, which is worth about $1 billion. By the way, last week he sold about $240 million of Amazon stock, although he donated it, so slightly different story, maybe for tax planning purposes. But long story short is, if you look at the writing on the wall, it's not pretty. So let's get rocking and rolling. American Eagle was down 17%. They had a weak projected forecast. Ford is scaling back on their plans for a 3.5 billion battery EV plant. So labor costs are going up. Why are they going up? Because they just agreed to an egregious amount to pay to the unions, to their workers, which again, if you actually look back at production of, American manufacturing over the last 10 years, it's decreased. So the union wants more money for doing less and less. I guess that's what everybody wants. It doesn't make it right. In my opinion, it's wrong, but that's what's going to happen. And ultimately, Ford and General Motors and all these other companies are going to go bankrupt again. They deserve it. And when they do, we'll do our best to profit by shorting the stock or going long companies that will survive it, like Tesla. Lowe's lowered their full year guidance. Like I said, they missed their third quarters, expectations and lack of home improvements, people doing home improvements. So why is Lowe's, and Home Depot as well experiencing a decline? Well, the cost of their material is up 400% in some instances, sometimes 700%. A piece of wood that used to cost $2 or $3 is now $12. That's a 300 to 600% increase. Rock wool, which I mentioned yesterday, used to be $30 a vat or a bag. It's now $80 a bag. Plus, in New York, we have an 8.625% sales tax. So $30 used to be $33, $80 is now $88. Everything has been increasing through the roof, and people are fed up, and they don't want to keep on spending their money. And the other issue is, it's not their money that they were spending, right? Everybody was out spending stimulus checks, overpaid unemployment. They had the mortgage moratorium going on. We had the PPP loans being given out. We had the EIDL loans being given out. We had increased child tax credits being given out, all sorts of free money. And when you're given money, you don't really care about it as much versus when you work for that money. Meaning, if I gave you $1,000, you're going to probably go out and spend it. If you had to work hard for that $1,000, you're going to do everything you can humanly do to save it and appreciate it. So it's much easier to spend somebody else's money versus your own money, unless you're frugally and fiscally responsible and prudent, which most Americans, unfortunately, are not. Best Buy cut their full year guidance. Consumer demand, they said, is, quote, uneven and difficult to predict. They were prepared for a customer who is deal focused. So they know that their prices are through the roof. Inflation has been going through the roof. Inflation is not going to go down. The Fed, if they do raise their rates, are going to cause a massive amount of new inflation to start. And, the whole economy, the whole country here is just a huge debt bubble. There's no other way to put it. The Fed still worried, according to their most recent meeting, which was October 31st, November 1st, 2023, where, it's November 20th now, November 21st to be exact. The Fed is still worried about inflation. Yeah, of course. Going off of the government's rig numbers, inflation year to date is about 4%. If you use the inflation numbers that we used in the 1970s, it's higher to 6, 7, 8%. And let's face it, you know the truth. You know the truth when you go out, when you go get your gas, when you get your food, when you buy anything at Home Depot, when you buy anything at Lowe's, when you go out to eat at a restaurant. McDonald's, Happy Meals are now $18, right? This is psychotic. It used to be $5, $10. It's now $20 at McDonald's. So to feed a family of 4 at McDonald's, I can't even say this because just saying McDonald's, A, makes me want to vomit, and B, the fact that it's $80 to feed a family of 4 there is completely asinine. So, they're up there with Chipotle and Cava and other high-end restaurants. So you have a family of 4, you want a cheap meal, I guess go to Wendy's. I don't know, go to Taco Bell, which, again, those places are also just as bad, fast food, unhealthy, gross, whatever, and probably the last thing you should be giving your kid. And no offense if you are. So long story short is you have Best Buy, you have Lowe's, you have American Eagle, you have Home Sales, you have Ford. Walmart came out and they lowered their full year guidance, I believe, and they said, due to, the consumer is weak. Target, same thing. They mentioned value 17 times in their third quarter conference call. And you have Jeff Bezos selling over, $1.2 billion of Amazon stock, which is hopefully to diversify. I mean, I'm sure the guy's already more than diversified. He's super, he's the third richest person in the world or in the country for that matter, make that. And the offset to this is everybody says the consumer is strong, the consumer is strong. And when I watch a CNBC interview of them talking about the consumer, they say how strong they are. And the people on CNBC should probably be fired because they don't acknowledge the 5,000-pound elephant in the room, which is credit card debt. Credit card debt has been going up through the roof. Auto loans have been going up through the roof. And, just personal household debt has been going up. So it's not the consumer that's strong. It's the credit card companies that are extending credit due to the Federal Reserve giving them money to extend. And at some point when these loans start going bad, then credit's going to be retracted and the consumer is not going to have any more debt to spend and be able to harm themselves and harm the overall economy. And when that happens, lights are out, right? We're going to have massive losses again. We're going to have banks defaulting, et cetera, et cetera. And I don't want to turn this into a 20, 25-minute video, so I'm trying to move fast. But moving along, the most recent Fed meeting said no, there was no mention of cuts, which I said before is inflation is still too high. Realistically, we don't need rates at 5.5%. We need it at 7, 8, 9, 10, 11, 12, 13%. That's how high interest rates should be. They're never going to go near there, unfortunately, but that's what we need to cleanse everything that's going on. Unfortunately, the Fed can't do that because U.S. debt, which, the U.S. debt of the government is over 33, 34 trillion, and we're going to be soon paying over $1 trillion in interest alone out of our $6 trillion budget. That's a serious issue. So, and the other thing they did say was economic growth too slow, which is what we need. And the caveat to that is then if the Fed does cut rates, then inflation is going to it hasn't stopped, but it's going to just get through the roof again. So there's not going to be a soft landing. It's going to probably be a very hard landing if the Fed does the right thing, which I don't think they will, which is either keep rates where they are or raise them. Inflation is not going anywhere. And, about a week and a half ago, the stock market, the markets basically read the most recent CPI that the Fed was done with lowering rates. The stock market rallied, the bond market rallied, and everybody thinks that the economy, that the Fed is going to cut rates. And the reason they will eventually cut rates, in my opinion, which is the wrong thing to do, is because the economy is weak and they need to stimulate it. And that's going to, again, keep on causing these bubbles on Wall Street to go up. And the list goes on and on. So CPI in October came in lower than expected. It was flat month to month, no increase, no decrease. Annual prices rose 3.2% versus 3.7% in September, and less than 3.3% forecasted. So versus 2%, you're still not anywhere near done with inflation, right? The Fed's target is 2%, which is absolutely stupid. Why would you want to spend more, 2% more every year when you go to buy something? You want deflation. I'm going to make a video on why we want deflation, as a matter of fact. And if that's something that you're interested in, please be sure to like, comment, and subscribe. And realistically, core inflation stripping out food and gas, which is insane because that's where you pay the most, right? Food, gas. The monthly numbers, it's 0.33%, which again, if you add up 3.33% times 12, that's 4%, still 2 times higher than their goal of 2%. And don't forget, if you compared these to the 1970s numbers, it would probably be 6 to 8%. Shelter increased month over month to 6 to 7% annually. Again, that's utilities, that's your rent, that's everything else. That's not 2%. That's not anywhere near 2%. And services increased 5.5%. And the bulk of the American consumer or the American economy is services. So, and they also look at services as a lead and indicator. I can tell you from my own personal experience at my firm, we keep on raising rates. Thankfully, more and more people want our services, so demand goes up, so our prices go up. But that's because we're doing the right thing. It's not that we're raising our prices and then people are coming along. It's supply and demand. So that's what we have to do. And cutting rates is just going to be stimulative. It's going to cause more inflation. We want rates to be much higher so people save. They earn money on their interest. They earn interest on their money. And to kind of tie all this together and avoid making this a long, drawn-out video, the solution is to A, save your money, B, buy physical assets, gold, silver. I personally have been on a tear with precious metal Rolexes, and I've been buying gold and silver. I've been buying dividend-paying stocks, Philip Morris, British Tobacco American, Enterprise Product Partners, EPD. I've been buying stocks abroad. I've been buying stocks in South America, some in China. British Tobacco American is obviously in the UK. So, and that's yielding 10%. Philip Morris is yielding 10%. Yesterday, Bayer crashed due to a Monsanto issue. They're yielding 5%. Is it a high-risk stock? Yes. Do I think they're going to go out of business? No. So that's on my radar for right now. But basically, you want to get out of the U.S. dollar. It sounds like an oxymoron, save as much as you can. Yes, but you also want to get out of the U.S. dollar. So anything you can do along those lines will help you. Buy in bulk. Save as much as possible, be frugal, be fiscally responsible. You don't need the next pair of Air Jordans. You don't need to go to Starbucks every day. And, yes, it's $100 here, $5 here, and it sounds like a little, or to some people it sounds like a lot. Look to cut your cost, of course, but all these small amounts that you end up saving are a cumulative snowball effect, and the more money you save, the more money that you're going to have. So if you found this video helpful, please be sure to like, comment, and subscribe. It means the world to me, and thank you, and have a great rest of the day. Happy Thanksgiving.